Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kurt Chisholm, and I'll be your host. So today I'm joined with Philip Hoffman. How you doing today, Philip?
Very good. Nice to speak to you.
Yeah, glad to have you here. So before we begin, this would be an interesting interview. Philip, tell us a bit about your background, what you do.
So I started as a CPA at KPMG and then became CFO of Christie's, which was the biggest auction house in the world. I ended up running that business on the main board from the age of 27. So I was the youngest director on that in that company at the time. And I left 25 years ago and founded the Fine Art Group. And now we do five different things. We're involved in advising some of the families around the world in 28 countries on how to buy and sell art. We do the valuations for trusts and estates and tax in the US. We do a lot of educational information for our clients, and we lend money. So we have funds that lends money against art, produces returns. We've run multiple art investment funds, and we've advised clients on how to buy wisely or how to avoid the pitfalls, and that's an interesting conversation. And that they can make serious money out of art, or they can lose serious money out of art if they don't really know what they're doing. And I'll give you plenty of examples of that.
Yeah, so the art. I wanted to have you on because I know this is I think it was about 15 years ago. It became an emerging asset class, at least in our field, from what we've heard. I know it's been around for a long time, but in terms of the investing community, considering art as an asset class, as a legitimate asset class, started. And I know some people have tried to create funds and other things. You hear about these advertised all the time. Um, but tell me, what is give me a high level overview of like the art industry from an investing standpoint.
So the actual volume of business in the art business is in per year is about 60 billion US dollars, which is peanuts by comparison to any other financial asset. The actual investable market is about 6 to 10 billion dollars. So 20% of that market. And the what I term art is a broad heading. So it covers jewelry, vintage cars. You can invest in handbags, Hermès handbags. We're talking about impressionist and modern art. We're talking about art that goes from $10,000 up to the most expensive art in the world that was sold was the Leonardo da Vinci at auction at Christie's 7 or 8 years ago for $450 million. And art in general is seen as an interesting alternative asset class, but how you do it and where you do it and who you do it with are the critical factors.
So, all right. So you said about 6 to 10 billion for the investing market, 60 for the market as a whole. What's the other 50? Where does that
50,
comprise?
it's sort of antiquities, it's sort of pocket watches, it's bits of furniture, it's collectibles, and there's when you go to an antique shop or you go to a dealer and buy a picture for $200 or $500, that is termed the art and antiques market. And that is not what I would term the investable market.
Okay, I get it. So it's more of the run-of-the-mill stuff, antique stores. It's not the high-end art market,
Correct.
which we were talking about. Okay, got it. So if somebody's thinking of investing in art, how should they think about it? What frameworks should they use in looking at this as a potential asset class?
So there are different ways to go in. You can either go in buying a share in an art investment fund or product, or you can go into private credit funds against art, or you can invest in art by buying art directly yourself, but you've got to be quite wealthy. Or you can syndicate an artwork between three or four or five of you. And most of our clients, the wealthiest clients, buy the art themselves. Clients with $250,000 or less, they have looked at art investment products, and I would say that there are there are important things to think about when you're looking at investing in art, such as you would with any other fund, front end load fees on an annual basis, percentage performance carry like a private equity fund. Some of these art investment funds are structured as private equity funds. Some are piece by piece. So you can invest in a fractional share of one picture. So you might be able to own $5,000 or $20,000 of a single Picasso that was bought for $10 million. But I would be, there are lots of do's and don'ts that I've been in the industry 35 years. And one of the things that everybody knows I bring is that I know the 25 things you shouldn't do when you invest in art. And there are a few things you should do when you invest in art.
Well, maybe you can talk about some of those. What are some of the things you should do? Let's start with those.
So if you're going to buy art for yourself, often it's a bit like real estate. When you buy your first house, and you buy it for $500,000, $1 million, and you sell it for $1.5 million after 5 years, you suddenly think you're terribly clever and that you could be a real estate developer or investor. And likewise, occasionally people buy a work of art and they buy it for 100,000 and suddenly they see it go up in value to 150,000. They think suddenly they're an art expert. And I advise massive caution. A lot of our clients, I had a client that was brought to me by one of the big US banks who'd spent $20 million on art. And he went up the main shopping street in Los Angeles, saw a particular gallery he liked. He was offered, most of the art was offered at like a 20, 30, 40% discount. So he thought, great names, big names, Monet, Picasso, Warhol. And he thought, well, if I'm buying these at a discount, this is great, great investment. And they tend to show you charts and graphs of how those artists have done. And when we were shown the artworks that he wanted to sell the whole lot, we valued them at resale. He bought them for 20. We value them resale, wait for it, at $4 million. So he lost $16 million. Why did he lose that money? Because like when you buy a house, you bring in an architect, a surveyor, your bankers, your financial accountants, your lawyers. Most people, when they buy art, they do it on their own. They think they're a successful businessman. All they've got to do is like the art, go to what looks like a good gallery or a good auction house. And if they get it at the low estimate of the auction, or if they get it at a discount, that's a bargain. And I'll tell you one story, which was a client of mine said to me, Philip, I've worked with a fine art group for a couple of years, and I've got the hang of how to buy art. And I found this amazing Monet, and it was sold at Christie's, which is one of the two biggest auction houses, Sotheby's being the other, for $10 million. And I've been offered the deal of the century. I can get a 40% discount on it. And he said, you haven't shown me Monet, classic Monets at 40% discount. He said, I'm going to buy it today because it's such a fantastic deal. And I know it's right because it was sold at Christie's. They got all the paperwork. And I said, look, why don't we get one of our team to look at it and check it over, check for condition. And there are about 50 things you need to check for an expensive work of art before you buy it. And most people think it's just two things. Do I like it? And am I getting what sounds like a good deal? And there are 50 things you should do before you buy that type of thing. And this client has missed the most obvious. So he bought it. He called us up and said, come and have a look at my great work. You'll see what a bargain I've got. And we sent along our expert who'd handled billions of dollars of Monet and knew exactly what he was doing. And he put the picture under ultraviolet light. And he said, look, this is a fantastic Monet, but with one problem. And he said, well, that was the Monet that sold at Christie's for 10 million. And if I'm right, the market's gone up, so it should be worth 12. And he said, yes, it should be worth 12, except for one thing. And he said, what do you mean? And he said, this picture has fallen off the wall, been smashed in 5 places, has been paid out by the insurance company 10 million, has been sold to a dealer for 1 million. The dealer's had 100,000 of restoration done, and he sold it to you for 6 million. So the owner looked absolutely distraught and said, what's it worth then? And my colleague said, it's worth 0. So the biggest lesson in that is that when you're buying art at a multiple of what you would spend on a holiday, it becomes an important investment. And when you're doing that type of investment, either become an expert yourself, and that takes years, or bring in the experts, and it doesn't cost that much money to do so. And they are effectively your advisor as you would in a piece of real estate. And that's the most important piece of advice I would give to anybody is get a reputable advisor. And most people don't do that.
Yeah, I mean, it sounds like good advice. I mean, you know, my dad was always into wine, so he was into fine wines, and back when wine was cheap, like he bought wines in France and Germany and all these places in Europe, like I don't know what it would have been like 70 years ago, like really cheap. Now those things are worth like $100,000 a bottle. Back then he got them for like a buck, like it just wasn't a big
Yeah,
deal, and now it's a big deal. And he got really into it, and he used to tell me he's like it's he wasn't into art, but it was always this flexible market where there was so many things you had to consider, and on top of that, there was so much flexibility in terms of what people would pay, and is this a good deal? Or, and good deals were rarely good deals. It was always, like you said, something wrong with them. Like nobody's giving you a deal. Like they can get it for top dollar. They're getting it top dollar. They're not giving you a deal
yeah.
because they like you.
Absolutely. And I had an example. There was an artist called Peter Doig. And back in 2005, when I set up my first private equity fund in art, we bought a Peter Doig, and the world record price for that artist at that point was 500,000 US dollars. We paid above that price. So we bought it for 880,000 from a law firm who'd bought it 15 years before for, wait for it, $15,000. So they were selling it to us for 880,000. They bought it for $15,000. Very nice compound return for them. And that paid for the entire art collection of the law firm, that profit. Now, we bought it, we held it for exactly 1 year, and we sold it as Sotheby's for 2.2 million US dollars. That is a beautiful deal. But what I did was I asked my advisor if, you know, one, why should we pay top dollar? Why aren't we getting a discount on an unknown artist? And he said, this is a really up and coming important artist. Two, I said, would you be happy to put 10% of your money into the deal so I feel comfortable that you're part of the journey? And he said, sure, I will. So there are a lot of people, and be wary. I had another example of a client who went to his local art dealer and went to the gallery and bought 40 pictures of polo horses and polo events, and he paid $20,000 each. So he bought $4 million of the same artist. That artist had no international reputation, not well known outside that gallery. And then he came to me through his bankers and said, Philip, would the Fine Art Group sell it? And I said, there is absolutely no market. The only way you can sell this is go back to the dealer and ask him if he'll take it back. And the dealer by that point has said, I'm really sorry, I've retired. I'm not handling art anymore. And you can understand why he retired. That market was dead. And so in buying art, there are artist names that I throw out, which may sound glamorous and glossy, like Basquiat, Picasso, Cezanne, Warhol, Pollock, Rothko. And people say that's out of our reach. But there are elements of those artists that are not out of the reach. You can buy a Warhol work on paper, a print. You could buy an artist like Bridget Riley, who's a British artist, for $30,000 or $40,000. And my view is that some of those artists could well be worth 10 times that. But rather than guessing or throwing a dart at a stock market and saying, let's pick this one because I like it, the value of getting a good advisor is enormous, and it costs a fraction of the cost of the work of art.
So is there like you mentioned earlier there's some history with certain artworks. Is there like a registry so like you can
Yeah.
follow along like, hey, this one's been damaged and claims have paid out and all this? Like, is there a registry that you could follow along? Like, here's the history of this art?
So there is, first of all, you can go on a website, and there are about five different art websites: Live Art, ArtNet, and you can look up the history of a particular picture. So you can say, I'm thinking of buying a Picasso, and you can go on ArtNet and look up all the Picassos that sold, and you can bracket them into price brackets. So if you're looking at a Picasso at, say, $1 million, you can see all the Picassos that sold at $1 million in the last 5 or 10 years or 20 years, and you can try and compare. But again, the next question is, and I had 50 collectors in the room in Aspen last August, and I put up on the wall two Monets, one that sold for 1 million and one that sold for 10 million. And I asked, and there were about 30 of them were massive collectors and had significant art collections. And I said, which one of you would think the one on the left is worth 10 million? And 90% put their hand up, and 90% of the room were wrong. Not that the one that they thought would make 10 million was in fact a Monet that sold for 1 million. So just trying to do it on your own or thinking you've got a bargain or it's a right brand name is beyond. I mean, it's just terrifying. But so many clients do it. But you cannot tell if a picture's damaged without getting an expert involved. Effectively, you put a picture under ultraviolet light, and that shows up whether it's damaged. But to somebody who doesn't know what they're doing, they wouldn't necessarily know. And if you're only buying a picture for $1,000, $2,000, it doesn't really matter, you like it or not. But when you're buying a picture for $1 million, that is essential. So we check that, first of all, we check it's not stolen. So the worst thing in the world you could do is find that you buy a picture from a dealer gallery and it's stolen, because you may have to hand it back and you lose all your money. Secondly, fakes. We get involved in buying between 500 million and $1 billion of art per year through the Fine Art Group. And when we sift through the art, we sift through about 10 or 20 billion. And probably of that 10 or 20 billion, when we're looking, 20% is fake. And I had a client who went to a regional auction house in the States and bought a small Warhol for 100,000, a small Basquiat for 100,000, and a few other works of the and those works of art came with a certificate of authenticity from a local auction house. And he came to us and said, Philip, could the Fine Art Group tell me whether these pictures are genuine? And we said, none of them are authentic. And they're all, in our view, they're all fake. And they said, but what about this certificate of authenticity? And I said, it's meaningless. The auction house are never going to, it's going to be of no use when you come to resell. So there are, when you are buying, I mean, if you go one of the big auction houses like Christie or Sotheby's, that reduces the risk of down to maybe 0.5% of buying a fake, a forgery, or anything wrong. And you have 5 years to recover your money. So if you did have a problem with those big auction houses, you'll likely as not get your money back if you notice it within 5 years. But I find that a lot of people really don't do their homework. But those who do their homework and are well advised, my view is that you can make somewhere between 8 and 15% a year on smart investments in the art world. And I'll give you some ideas and thoughts on that in a moment.
Okay. So, so 8 to 15%, that's interesting. So of that, I assume different asset classes within the art space. You're talking about handbags versus, paintings versus something else, jewelry, whatever it is.
Yeah.
Are there different return streams that are kind of historically accurate, or is it just kind of generally just all in the
No,
mix?
the areas to invest in are what I would term rare. So if it's rare, unique, A-grade quality. So let's say if you've got a lot of money and you want to buy a Monet, you're better off buying the best Monet that is in great condition and paying a huge price than buying 10 cheap ones that you think that are average, badly done. And that's the case across all the art market. So for instance, in jewelry, people collect Cartier jewelry because Cartier is one of the greatest makers of jewelry in the world, and they collect antique Cartier jewelry. Where do you find that? You could buy it at auction. You can buy it from one or two of the dealers, but often you find the markups huge. So you might be able to find a beautiful color, a mixed diamond, a diamond and colored stone bracelet by Cartier, and it might cost you a few $100,000 at auction. But if it's authentic, if it's said that it's by Cartier at the big auctions, then it will be, and something like that could be a very good investment. If you bought, there's an artist like I'm going to give you some British artists that I think are particularly interesting, just because I follow that market quite closely. Bridget Riley, Frank Auerbach, Henry Moore, Barbara Hepworth. They're all big names, particularly interesting. American artists, Warhol, Basquiat. I mean, if you could buy, if you were wealthy and had $10 million, $20 million, I would buy Rothko. Right now, when we're doing this podcast, I would say this is the best time I've seen in 20 years to buy art. It's down by 20 to 30% from 3 to 5 years ago. I would say that what was selling for 2 million, you could probably get for 1.25 million. What was selling for 800,000 is probably available at 500,000. But again, you've got to understand and have someone advise you. And to get a good advisor, you might pay them 5 or 10% of the price you pay, but you'll save a fortune in mistakes by hiring them.
So why you mentioned it's down 20 or 30% from a few years ago. What do you attribute that to?
So art, when during the 0% interest rate COVID period, art soared because people wanted real assets, and art was one of the beneficiaries of that. And then when interest rates hit 4, 5, 6 plus a margin around the world, the cost of debt made art less attractive, and people were looking at other areas of investing. And what we have seen with the volatility of the stock market in the last 6 months is that art and higher interest rates, that the art market was rather overheated and has come off by 20, 30, 40%, certainly the top end. So there are probably 70% of the top artists are down 20 or 30%. So if you look at the auctions that took place, and you can gauge this by going to the New York auctions in May and November, and I turn up to all those auctions, I go to the art fairs, and you would see there was a Mondrian that made 45 million, and probably in its heyday, with the wind behind it, might have made 60 million. There are works by Warhol that would have made 30 million or 50 million, and today are making 20 million. And I think those works will be back up at 30, 40, or 50 million in the next 5 to 10 years. So if I could pull a couple of $100 million together today, I would be definitely investing in the right sort of art. That's not all art, and that's not art at the bottom end at below $10,000, $20,000. And that's not necessarily at the art at $100 million that we all read about. The Klimt, one of our team in Hong Kong bought a Klimt for 108 million for one of our clients. Now that's out of the reach of 99% of the world. So you can invest in art in buying with good advice and buying individual pieces. There are, and I want to give a word of warning, there are fractional vehicles available in the United States that offer the opportunity to buy art. And the biggest problem with that is the associated costs. And some of those costs can amount up to 20, 30, 40% compared to buying a stock where the costs are 0.01%. So on a $10 million work of art, you could find yourself incurring on a $10 million work of art, 2 million to 4 million in associated fund costs, which are nuts. And so I warn clients away from some of these fractional opportunities because of those costs. But where the costs are right down at, um, you know, 2 to 5 to 10%, that's a very interesting opportunity to acquire great art. And I think over the next 10 years, if you bought a great Warhol at $5 million, you probably see that at 10 or 15 million. If you bought a great Bridget Riley in the London market for 1 or 2 million, you'll probably see that at 4 or 5 million in 10 or 15 years time.
It's interesting that the fractional ownership is that expensive because I mean, if you're uber wealthy and you can afford art, then obviously, unless you're a real expert, I would assume most of them would use somebody like yourself to acquire art so they don't get duped.
Yeah.
Um, but the average person is not a bazillionaire, and even if they are, they're not buying bananas on a white piece of on a wall that you put duct tape on it and spend $1 million. That to me is ridiculous, but hey, people are ridiculous. So what are some methods people can do to invest in art without being experts, without paying 20 to 40%, transaction costs? Like what are some
So
methods
you
that
can
most people can invest in?
so if you've got $1 million to invest, um, I would probably hire an advisor and buy 3 or 4 works of art that you like, that your advisor thinks are wise investments, and they can show you the comparables. So when I advise a client, we don't just wander around an art fair or an auction and say, "Oh, that looks nice, that's cheap." We actually do a lot of due diligence before, during, and after. And a lot of our clients uh, want to own art, jewelry, and you can first. So number one, get advice. Get advice from people who have a track record. Secondly, don't put all your eggs in one basket. Thirdly, don't go too cheap. Don't try and say, "Oh, this is half price or reduced or whatever," or "This is a great name, but I've got it for a fraction of what a great picture might make." So you buy the best you can afford. Then get your advisor to do some other checks, like has it got all the provenance? So we talk about the word provenance. That means history. And most expensive works have a history of who owned it before. And if there's no history and paperwork to go with it, don't buy it. It's really dangerous. So if you're buying, let's say you're buying um, a Warhol for $500,000, and there is no paperwork to show who the previous owner was, what they paid, who the owner before that was, be on guard, because there might be a problem. Because all these artworks should come with an attached history. And if it doesn't, there's a warning sign that it might be a fake. And again, if it's too good to be true, if you suddenly see a a great looking Warhol that should be 500,000 being offered to you for 100,000, it's probably fake, or it's a forger, or it's stolen, and you're going to lose your money.
So in your experience, how much of the investing in art from wealthy people is investing and how much is for personal enjoyment?
I would say that 30, 50 years ago, it was all personal enjoyment. Um, but then when people saw what the Rockefellers and the Mellons and the Paul Allens of this world did, I mean, Paul Allen sold his collection for 1.6 billion, and he probably paid a fraction of that. Um, Now, that's at the very top end. Um, what do people do? Most of them uh, probably look to put 5% of their wealth into art. You can put it into a fund. We run a private credit fund and something like that, where you lend money against art, and it's like lending on a mortgage. So when we lend money against art, we lend money at 50% loan to value, and the investors generate around a 10% yield. And that's quite an interesting yield in today's market. And that's paid out as dividends every quarter. So you can do it investing in a private credit fund. And that's one way of getting money, investing in art. The other is investing in a properly run fund. And there are very few of them in the world. And with low charges and good expertise. And the other is art is not a short-term bet. If you're investing in art, you should really be looking at investing for a 5 to 10 year period. So don't think you're going to get in and out in a week or a month or a year. We, as a company, when we've been investing in art, we always bought privately direct from the owner, and we sold a lot at auction, probably 50% sold at auction, 50% privately. For the average person who's trying to buy art, it's difficult to know where to find that art privately. And that's why using an advisor who knows their way around the art market is incredibly valuable. But otherwise, if you want to take a long-term view, if you buy art at auction and get well advised, there are opportunities. But again, you've got to remember that the auction costs, the spread, is possibly 20 to 30%. And so the art's got to go up by 20 or 30% before you recover your money. So that's one of the issues about buying at auction these days. And that's why, again, you've got to take a long-term view to recover that cost.
So I want to pivot with one question. So 10% yield on a private credit fund. What are the risks in something like that?
Well, there are about 3 or 4 big companies that have run private credit funds effectively, and the losses on most of them, of the big creditable ones, is peanuts. In fact, they most of them have lost none of the capital and recovered most of, haven't lost any of the interest either, and that's the case for the fine art group. And so why it's so sensible is because we value, for instance, we value the art. Let's say we value a Picasso and a Warhol at 10 million. We then lend 5 million against it. So we're 50% loan to value. We typically take possession of the art. So then we actually have it. So if the client defaults, we have we can go back to the client and ask for the money from him, or we can sell the artwork. And given that we've got a track record of the fine art group of having handled hundreds of millions and in fact billions of dollars of art, and our track record is we have on average never lost 50% across a portfolio of art. The worst I would expect is 10 to 20%. So lending a 50% loan to value is a very safe number. And clients like to borrow the money because that's an unused asset that they can create liquidity. So we can lend money in a week, and that's much faster than any bank could do, and it's just against the art asset. And so clients pay a higher cost because they're only giving the art, they're not giving a cross collateralization of their stocks or their property. And so for us, it's a very good dividend yield. For the client, it's a very quick way to source money. And for the client, they can do it on a short-term basis, 1, 2, 3 years, and roll it over.
Okay, no, that makes sense. So one question that comes to mind. So I live in Boston or Boston area. I'm sure you're familiar with the Isabella Gardner Museum robbery. That was back 35 years ago.
Yeah.
There's a statute of limitations. Could somebody just, whoever stole that, go and sell that art? And would that be acceptable? Like, how does that work?
Every country has a different rule about the statute of limitations and theft. So in the UK, if something is stolen and I buy it, and the police come or person finds out, there is no limit. People can claim that work back, and whoever bought it loses all their money. So there are checks you can do. So there's something called the art loss register that anything that is stolen is logged on. So before you buy a work of art, especially an expensive one, you go on the art loss register and check. You put in the title, the work, the name of the artist, the date, and as much detail, and then you try and match it up to the art loss register and see if it was recorded as lost and stolen. And that's a very, very important way of doing a first check. Um, and then again, you can ask an advisor to do some diligence for you. But again, when I get offered works at a discount or from a strange person, I'm probably on notice there's probably a theft or a forgery or a fake flying around.
So, it from what I understand, obviously there's a black market for this because
Yeah,
there are many stolen arts and people still trade them, just not through auction houses.
yeah.
So how does give me some insight into that world, like just from, the public standpoint, so people understand how that generally works.
So obviously, jewelry is the easiest thing to steal and break up. So what happens is that a diamond ring gets stolen, or a valuable piece of jewelry gets stolen from a museum, and they break up the whole thing. So as a Cartier piece, it might be worth $1 million. As individual stones taken out of the Cartier piece, it might be worth $100,000. But the person who's stolen it doesn't really care. He just wants to get cash fast. If somebody steals a famous Monet, in the public market, it's probably impossible to sell. You wouldn't be able to sell it through any reputable dealer or any auction house. You could try and sell it privately, but you would probably get picked up. It's really at the bottom end. And I'll tell you a very funny story of a extraordinary story of a very famous art dealer who had about 50 million of art, and he sold most of it. And he had about 10 million left, and he couldn't sell it. And he insured it for 10 million. It was probably worth $1 million. And he went out to dinner with his wife. And during the dinner, he said, "I've just got to disappear. I'm not feeling great. I'm just going to go to the men's room." And he rushed back home, which was about 20 minutes away. He smashed a window, let the burglars in, and got them to steal the entire art collection that he couldn't get rid of, and got the insurance payout. And it only came out after his death that he'd overseen this massive insurance fraud. And they then burnt the pictures, and he got the payout of 10 million. So there are all sorts of frauds and fakes and forgeries going on in the art market because there's so much money involved. And if you a fun story about, there's not just things, theft, but damage. I outlined that Monet example, but here's an example of damage that enhanced the value of. There was a Banksy at Sotheby's that shredded through the sale. I was at the sale when it happened. It hammered down at the auction at £1 million, so $1.5 million. And as it shredded, everybody thought it'd become worthless. Well, it resold at well above 10 million. I think it was 25 million, because it was so famous and every newspaper had written about it. So not every bit of damage necessarily reduces the value of an artwork, but 90% of the time, 99% of the time it does. But there's a rare example of not.
But that certainly brings up the idea that, what is art actually worth? Like, what's its intrinsic value? And it's obviously what people want to pay for it.
Yeah.
In that case, it's famous. Um, but I'm sure it wasn't because they thought it was beautiful to look at. It's just like, hey, there's this. I remember, like, with baseball cards when I was a kid, there was a Cal Ripken Jr. Rookie card where on the butt end of the bat, he was sitting there like this, and the butt end of the bat had some curse words on there. There were like a handful of them, and it was like really valuable just because it had that on there. Like none of them had it, but somebody had a joke and wrote some, and it was legit, and it was like it was
That and
famous just
that
because of that.
and that's the case. So yeah, I always said to everybody, if I sold my Rembrandt and the Queen or the King had the same Rembrandt and put theirs up for sale, mine may make 10 million and theirs might make 100 million.
Yeah.
Why? Because it was owned by the royal family, as opposed to owned by Philip Hoffman of the Fine Art Group.
Philip, you need to become more famous. I'll tell you. You gotta boost your stature. Oh
But
man.
I remember again one of our big Atlanta clients invested in bought a cause painting by an artist called Kaws, Kaws, and he bought it from a LA gallery. And this was his first venture into buying an artwork. And he had no idea, but he thought if he goes to a reputable gallery, and he spent $250,000 on it. And he said, look, I want it shipped to my new house in Atlanta, and I'm really proud of it. And just tell me when it arrives. Anyway, he comes back from holiday, and the cause had been delivered the week before, and UPS had left it on his front lawn. And when he arrived, it had rained, the crate had collapsed, the cause was ruined. And he rang the gallery, and they said, look, you didn't ask about insurance with us, so we assumed you insured with UPS. He rang UPS, and they said, sure, we'll give you the $250 for the crate, but we didn't insure the picture. So that was a bad start for a first time buy. And so when you're buying art, there's another lesson. And I had a very funny story of a client who owned a work by Damien Hirst, the British artist who did those famous butterfly paintings and the sharks in the fish tank. And in this case, it was a medicine cabinet. And when you move art, do it properly, do it carefully, and don't just have a go yourself. So in this case, here's an illustration of a story of how to mess it up. Um, this very, very important art insurance owner, in fact, asked an art company to move his art, and he was told it was going to be $2,000 to move a medicine cabinet with 100 medicine bottles in it from his office to his new office. And he said, I'm not paying $2,000 to move it. So he said, he called up his driver, Bert, and he said, Bert, could you move it for me? And he said, I'll do it. I'll do it in an hour for you, sir. And he said, no, handle it carefully. It's very valuable. It's worth $1 million. So just be careful. Anyway, Bert was standing at the front door of the new office, and the owner of the business walked in, and Bert said, Governor, you won't believe how wonderful your Damien Hirst looks. And he said, well, it looked very nice in the old office. Why does it look any better in the new office? He said, come and have a look. And he said, I've cleaned the glass. I've turned all the bottle. I've emptied the bottles that were empty. I've thrown away. The bottles that were left, I put in descending order, and it looks much neater. And he just destroyed £1 million, million and a half, Damien Hirst. Luckily, they found the bottles in the dustbin, and they managed to recreate the piece. But just get the professionals in. And there's a lesson throughout this conversation, is that you can, if you invest millions of dollars into art, you can make millions of dollars out of it. But all the people who've invested or bought art have got a smart advisor to help them along the way. Initially, it might be a free consultation and say, look, I'm looking to buy this Warhol at Christie's or Sotheby's. I've seen it on offer. What would you suggest? And get some guidance, or do your own research, but spend days and weeks on it. Don't spend minutes. And then if you're going to seriously go into the market, there are probably 20 or 30 art advisory groups around the world who are smart at doing this. And go to one of the best. A bit like when you're trying to, invest your family office money. Get some smart advisors to help you, and don't just try and have a go at guessing which the best stock is just because you like the name of the stock or the company.
Yeah, no, this has been great. It's been great insight. One quick question. Do you guys deal with wine labels? Because some of the vineyards have hired artists to create labels way back 50, 75 years ago.
So what's happened is that these bottles, like Mouton Rothschild is the Rothschild is one of the great names that they use famous artists for, and there is a collectability, but that's not where the money is. The money is in buying those bottles that are being used, shipping them to China, where they are rebottled with wine that is probably about $100 a bottle, and they then recork it, reseal it, and sell it as original Lafite or original Mouton Rothschild at $2,000, $5,000, and $10,000 a bottle. And again, there's a huge fake industry in the wine business because of those labels, and people like, can recognize the bottle, but they can't recognize that it's been recorked.
Sounds like that's an overlay for the entire art industry.
It is, but I've been in the art business 35 years. I've run the biggest art auction house. I've run the biggest art advisory company. I've seen people make a huge amount of money out of art. And I've seen most wise family offices allocate about 5% of their wealth to art, but they've done it smartly, not on the quick and dirty and cheap. They've learned from others, and they've taken good advice. And those who have put aside 5 or 10% of their wealth into art over a 20-year period have found that it's probably grown at the rate of 8 to 15% compound, which is a pretty attractive return compared to the S&P 500 or alternative asset classes. But you've got to take a long-term view. You've got to buy with a smart advisor, and you've got to put a reasonable amount of money into it in the first place.
Nice. Well, Philip, I really appreciate you coming on the show. Where can people find more about you?
So you can either go to www.fineartgroup.com, or you can go on LinkedIn, Philip Hoffman, the Fine Art Group, and you can find out a lot of us. I'm often in the press, Bloomberg, BBC, CNN. You can follow some of my commentaries on all the video podcasts.
Nice. Well, Philip, I really appreciate you coming on the show, and yeah, we'll have you back on the future.
Brilliant. Thank you very much for inviting me. Best wishes. Bye-bye.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Philip. Really appreciate him coming on the show. Now we're into the panel portion of the show where you have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here. Looking forward to talking about the world of fine art.
Yeah, this will be fun. And also we have our very own Doug Hagren. Hey, Doug.
Hey Kirk, yeah, no, I'm excited about not just art, but just, this new kind of culturally relevant interest in trading collectibles of any kind that's really blown up over the last decade or so. Almost kind of a subculture. I think this is there's so much to unpack here.
Yeah.
Like out of the crate, no joke intended, of course.
Yeah, no pun. Yeah. So Phil, what were some of your takeaways from the interview?
So this is not an area that I would delve into myself, but it's a fascinating subject. I know that a lot of people are interested in. I know there's like you can buy fractional art, and one of the things though that really struck me when he was talking about this was when he said that because of how this industry works and the commissions and the fees and everything involved, you need like a 30 to 40% increase in the value of what you're buying to be able to make money. And like to me, that's a world that I don't know that I want to go into. Like you think about in the older days when mutual funds and all that had these big sales charges and like 6% hit up front. And that was pretty big to overcome, but 30 to 40%, that just seems really pretty crazy to me.
Yeah, no, I totally agree. Doug, what about you? Thoughts?
Well, Phil, you touched on something. And with the fractional share, as a matter of fact, I get a regular email from an organization that I'm not going to mention the specific name, but they're basically they're out of New York. They're in the business of basically getting people to be able to have this access to art that would typically have been inaccessible, right? Art is something you go to, you go to the auctions, and you hear these stories about Van Gogh's selling for millions and millions of dollars, and it's been relatively inaccessible for the general public. Even accredited investors have not had access to that because you're not talking about something where $250,000 income and then you get access to the syndicate. You're talking about something where 25 million and you get access to to the syndicate, the art show. And it's one of those where if you found yourself because you're hot in the room, all of a sudden you're on the hook for buying the Van Gogh. It's like starting bid, $12 million. Write the check. You sign the contract coming in. It's fascinating. So, just the other day, I got an email. Another Banksy is on the way. Complete your call for Banksy access. Banksy launches tomorrow. I mean, I'm going back over, months. It's trying to load. We've had, Banksy's been their hot one, over the past couple years, but a lot of the names. It's big. The other thing that's really big is to me, there's this growing trend that has kind of developed in collectibles relevance. I think it's an interesting. The nostalgia is huge, and you're seeing more of like older bands that are kind of coming back and older trends that are coming back. There seems to be, especially Gen Y and Gen Z are driving this collectibles back into relevance. Growing up with sneakers, trading cards, pop culture as core identity markers. And they don't see collectibles as childish. They see them as cultural capital. I mean, Pokemon cards worth millions, Air Jordans worth millions, Funko Pops are modern equivalents of wine cellars and stamp collections. So there's this kind of nostalgia meets assetization that's occurred. Digital has allowed for transparency. You've got platforms like StockX, Go, PWCC, eBay. Now you've got real-time pricing, authentication, liquidity. These have now all become these crazy quasi-financial instruments with visible market depth. And then, Philip Hoffman's kind of that, pioneering it for fine art, but now it's extended into all these other broader pulp culture markets. I think, a desperation in a way, from these younger generations to try to figure out how to accumulate wealth that has, you can read has been very difficult to tap if you look at who's got the wealth and the baby boomers continuing to work and, continuing to hoard assets and, in many capacity. I think that's led to a financialization of everything, whether it's crypto, NTFs, that's created this comfort with treating intangible culture as investable. And then, of course, while you've even actually gotten the traditional collectibles. There's been a crossover. Even Sotheby's and Christie's are now selling sneakers, Supreme gear, digital collectibles alongside of fine art. So now there's this blurring of boundaries that's kind of validating that the Gen Z markets, these Gen Z markets to older investors, while pulling Gen Z further into a collectibles ecosystem. So when you take all of this together and then combine it with the fact that there's been a massive injection of capital over the last, decade or so, I think it's just opened up this new this new not plateau, but this new horizon of being able to take anything, and whether real, tangible or not, and turn it into something that has a bartering system of value. It's interesting.
Yeah, I mean, to be honest, I find the whole area really interesting, and at the same time, makes me wonder how much longer it goes because, for so long there was an art market of basically people who just enjoyed art. And now there's just a bunch of really obnoxious wealthy people with FU money that are like, well, I gotta be cool, so I gotta buy some art. And they're not really into art. They're into the facade of looking rich and, being a part of the club. Um, and it almost feels like and to be fair, every asset has a bubble at some point or another. And it kind of feels like it's that, where a bunch of rich people fight. I just saw the other night the Thomas Crown Affair, which phenomenal movie with Pierce Brosnan. Love that movie. And I saw it, and Dennis Lear is in that movie, and he's like, at the end of the movie, they're just like, "Oh, you're gonna go after him?" He's like, "What do I care?" He's like, "It's just a bunch of rich people chasing around a bunch of swirls of paint." He's like, "I stopped like a he's like, I stopped, a father beating on his son the other day, so that's something, and I was like, it's so true. Like the art world is um you have a handful of people fighting over a price, and you know I don't know. I'm trying to be fair because art isn't my thing. But at the same point, it's why is it becoming such a big deal? You have these fractional companies that fractionalize art so everyone can buy a share. And from what I've heard from one company, I won't name them. From what I've heard, this one company, it's like questionable, on many levels, which so I'm not saying the name. But the point is yeah, everybody can get access, but should they? It's like now they're giving access to the mom and pop investors for private equity. That's usually a bad sign. When they either don't have any money or the institutional investors have run out or aren't interested and now they want to sell it to mom and pop, that's a bad sign. Okay, I'm just saying. Right away. Now, 10 years down the line, that might be fine, but someone's going to get burned if you're in early. You got to wait for that bubble to pop, and then you can get in as mom and pop, but I would not get in. It's kind of like art, the same thing. Like, I don't know when it pops
NFTs.
or if it pops,
Yeah.
but but there's different kinds of art. I mean, we talked a little bit about on the interview, but there's different kinds of art. There's obviously paintings, there's sculpture, there's you can get into collectibles like vintage cars or vintage jewelry. I mean, there's lots of different things that people can collect. I mean, how would you look at it, Phil? I mean, would you tell people to invest in this? Would you tell your clients, hey, you needed to be diversified into art because you need some low correlation assets? Like, how do you look at it?
I wouldn't tell people because one of the things that Phil talked about during the interview was the idea that you have to buy wisely, right? You have to know what you're doing. And look, I appreciate art, and I'll tell a story about Van Gogh in a second because Doug brought him up. But I appreciate art, but I'm not an art expert, and I wouldn't know how to tell if it was real or there's forgeries, right? I wouldn't know how to tell any of that. I don't feel comfortable making a decision or making a recommendation around art. The only way that I ever think about it, I mean, maybe if you work with somebody like Philip, right? Because he knows what he's doing. It doesn't have to be him, but it has to be somebody like that so that you could help you bridge that education gap because we don't have it. Um, but I want to bring up this story about Van Gogh because this summer, as part of our vacation, we were in Amsterdam. And there's a Van Gogh museum in Amsterdam,
Been there.
and Van Gogh and Monet are probably my two favorite artists. And the Van Gogh Museum, I've been to Giverny, which was where Monet's home was, but the Van Gogh Museum, like the story that they weave through the museum is just amazing. And so like the part that is the most amazing about it, Van Gogh, when he was alive, he wasn't successful. He wasn't known. He had a brother, and his brother Theo thought that Vincent was talented, and Theo sold art, and he lived in Paris, and so that's why like Rembrandt is also a Dutch artist, but he's more like how the Italians paint, right? But because of Van Gogh, his brother was in Paris, so that's why Van Gogh's painting is more like the Impressionists. So Theo thought that he would be a successful artist. And one thing too, you see a lot of self-portraits that Van Gogh does. That's because he couldn't even afford models. So he would stand in front of a mirror and paint himself. Anyway, a little while before Van Gogh ended up killing himself, his brother got married. And his brother and his wife, they had a baby that they named Vincent after Van Gogh. And Vincent was actually upset about this because he thought he should have named them after his father. But anyway, 5 months after Vincent van Gogh passed away, his brother got ill and he also passed away. And so here's this woman that he married who hardly knew Vincent, but knew that his brother thought that Van Gogh should be well known and popular. So she made it her mission to make him known. So the reason that there are some Van Gogh paintings that are in circulation is because she did sell some of his art, but it was to help build his name up. And this museum was built because of the efforts of her and her son Vincent, who later became a mechanical engineer. The two of them did all this work to build this museum and make him known. Nobody knew who Van Gogh was when he died, really. I mean, he knew some other artists, like he was friends with Monet and things like that, but people didn't know who he was. But this woman who hardly knew him and wasn't even married to his brother that long, it was through her efforts and then the help of their son, who was named after Vincent, that really made this museum, made Van Gogh who he was, who he became now. Like, because we think of him as this wonderful artist, but nobody even knew who he was. And it was all through their efforts. And it's just like, it's such an interesting story. And I never knew any of that, like how he became known. I knew that he wasn't well known during his life, but I never knew like what changed. The other thing I wanted to talk about too, it's really interesting to me. We think about the younger generation and they're supposed to be minimalists and they don't want stuff. But yet here we are, and Doug, you talked about all these different, this nostalgia and all these different collectibles. So we don't want stuff, but yet we're trying to make collectibles. It seems like it's a bit of an oxymoron in a way, right? Because we don't want stuff, but yet if there's the stuff that's got nostalgia collected to it and connected to it, we can make it into a collectible and now it can be worth something. Just, it's just an interesting dichotomy. And the other thing we talk about all the other things. This week, I saw that a record price was received for a sports card. It had Michael Jordan, and I forget who the other athlete was on it, another famous athlete, and I think it was signed, but it was $12.9 million. It's crazy. And like I know that like Gretzky cards and Mantle cards, I think Mantle was the one, the 51 Mantle is a very rare card, and the one that was in the best condition, I think was 7 million or 9 million, but this one easily surpassed that. But it's crazy, like the values they get assigned to these things. And like that's the other thing too. Like you invest in this stuff and people decide what they're worth. And it's, supply and demand. And I know all that factors in, but 10 years from now, 20 years from now, do we know that somebody's going to still be willing to pay that kind of value for whatever we decided it was worth today? That's another thing that's hard. I mean, I know stocks have things that make them go up and down and we can't price those with certainty, but at least we have a little bit more information and we have a chance. For this, I just, it's hard for me to recommend because it's hard for me to think that I have any way to have any type of real knowledge that I could share that would lead to benefit and help my clients out. So it's not something that I would typically recommend to clients.
Yeah, it's interesting. I mean, if you think about it, how many starving artists are really talented and they remain unknown, right? Like Van Gogh, like you said, like probably wouldn't have been known except for the work of his sister-in-law, right? I mean, that's crazy to think. I mean, I could tell you that my brother-in-law is extremely talented, but he's never going to be known. Like he doesn't want to be known. Like just he's just so he's like, and it's funny because I've seen his stuff, and my wife talks about this all the time. I've seen his stuff. Like he paints on some murals and on certain restaurants, and holy crap! And she talks about it. She's like, he'll do this thing, and it'll be absolutely amazing, and it'll just tear it up and be like, "Oh, that's terrible." I'm like, "No, no, no, no. Keep it. Give it to me. It's beautiful." And I think it's I always find it to be really interesting because I don't know a lot of artists, but I know that usually the best ones are a little bit cuckoo. Like not crazy, but like there's something I'm trying to think how to say it because I don't want to make it sound like these people are crazy. But like it was who was it? Dali. I was reading about Dali years ago on how he tried there's like a state of mind you have to be in to have real talent. Like you can't be like the logic engineer and you can't be like so far out on the other side where you don't have a touch in reality. But there's like this space. I think this is what Dali used to do. He tried to put himself in this state where brilliance would just happen. And I don't know how to describe it because it's been a while since I've read about this, but it was something akin to being like a little bit drunk or a little bit high. Like not like super high. And I'm not saying he used drugs. I'm saying I think he did. But that's not what I mean. But I mean there's like a state that you're a little bit off. So perfect example like Silicon Valley a lot of them take microdosing of like LSD or mushrooms or DMT or there's some hallucinogenic that they'll do microdosing because it provides something a little bit of creativity that they ordinarily wouldn't have. And that's what I'm getting at. There's like a state of mind that you can put yourself in a little bit where it's like brilliance comes. It can't be too much or too little because it won't be there, but some people are trying to scientifically design that. Um, and so I find it interesting that like there's probably a lot of really talented artists that will either never be known or their art will never be worth anything, even though it should be. Everyone's focused on a handful of artists that they've collectively deemed as these are the greats, but you know, it's people are buying the name a lot of times and not the art. Now, I do know a lot of people who buy art for its beauty, and they will definitely not pay up for the high end stuff. They've actually found niches where they're able to buy art that is beautiful and they understand art enough so they'll buy it at a good price and then they'll sell it later for a much better price because they know the art world enough where we talked about in the interview with Philip like he's talking about the high end of the market. The high end is where all the profits are. I think I talked about this. If you're buying like old hyperinflationary money. You always buy the highest denomination because that's worth the most, like multiple X of the next denomination. Same thing with the art world. The highest end always multiples better than the second tier and the third tier. Um, Now it might be more affordable to buy the second and third tier for most people. But at that tier, you should probably be buying it for the enjoyment of the art, not necessarily for the price because you're not going to get the same monetary benefits if that's why you're doing it. Um, so I think art's is an interesting thing because there's so many pieces and there's not the liquidity isn't there. So you have to really buy it for the personal enjoyment unless you just have extra money to spend and you're trying to impress people, which it was a Steve Ballmer who had an impressive art collection. It was like one of the billionaires. Was it him? I don't know if you guys know. I think it was Ballmer who
I
had like an
think it's, if I'm not mistaken, I could be. It's the Mets owner,
Steve Cohn.
Steve Cohen.
Yeah, I
I
think
believe.
you're
he
right there.
also had one, but there was one of one of the tech guys, I believe, had an extraordinary art collection. It was extremely well known that it was a good collection. But it might not have been Bomber, but it was anyway. But the point being is these people have like hundreds of billions of dollars, like whatever. You
Oh,
know?
Paul Allen,
Yeah, was it
definitely.
Paul Allen? Okay,
Yeah,
yeah,
I
that
think
might
it's
have been
Paul
it.
Allen. Paul Allen
Okay,
was, this was huge for him, and he truly, authentically. I mean, Paul in his own
yeah.
right, very very deep into his love of art, and more than status. But Paul kind of lives in his own island there in terms of the way he looks at things.
Yeah, yeah, totally agree. Um, cool. So what do you think, Doug? I mean, is this something that you'd talk to your clients about and say, hey, you should have 5% in art or collectibles or really anything that's this kind of fluid in terms of pricing?
Well, here's the problem. So you've got these groups out there, like I just like I was mentioning that um are marketing this, like you said, it's, it's kind of a bragging rights. It's a flex culture as a hook. So instead of talking about diversification or wealth preservation in dry financial terms, it's a social flex. Actually just looked at one of the emails. It says, "I have a Picasso in my portfolio," quotes. "Watch your relatives' faces when you casually drop that while eating Thanksgiving leftovers. While they show off their Black Friday purchases, you could be discussing your steak in an art, not a T-bone, but in an artwork offering featuring Picasso, Banksy, or Basquiat. It's the same asset class that's helped build a portion of generational wealth for decades. This weekend, skip the retail chaos. Join other Masterworks investors who are diversifying their portfolios and legacy one artwork at a time." Well, here's the breakdown of that. In order to do that, they have to fractionalize it. And if you fractionalize it, you're not really into the artwork. It's kind of like the argument around accessibility to crypto and Bitcoin through ETFs, right? Do you really own the BT? Do you really own Bitcoin? Do you really own the the crypto itself? I mean, technically, with ETFs, you could exchange it once you have enough. But the reality is, once you start institutionalizing it, you've completely defeated some of the original premises and mandates of what it is in the first place. And I think that's the challenge with it. I think that a lot of it goes back to, it is a bragging right. It's exactly what you said. They're playing off scarcity, and or they're playing off of kind of attitude. I mean, what was NFTs? We talked, I mentioned that NFTs were all about, I mean, you can't pick a point in history where people more willingly threw good money at nothing. It's like, hey, ugly frog that everybody's got. All of a sudden you find out this musician, writes a $25 million check to own the rights of something nobody could give two bits about, right?
Yep.
And it's gone. It's literally, we thought pets.com and buy.com was a fleecing of wealth. Holy smokes. I mean, $25 million for an NFT that is evaporated money. And that just tells you the kind of things we are. But it was bragging rights, right? All they wanted to be able to say, "I bought this ugly frog," or this, crying frog, or whatever. I just remember a bunch of stuff going down. So would I recommend
Bored
it?
apes, Doug. Bored
Yeah,
apes.
yeah. Bored apes is another, exactly. So this is this would I recommend it? No, not right now, because there's not really an authentic way of getting into it, and in a way in which you're truly owning that and control of that asset. Now, again, maybe over time it becomes more normalized, or it becomes more, might see, and again, is this the right way? ETFs is a way of having an asset class, and it's tied to the asset class, it's in the elevator, and all you're really trying to do is catch the wave of the elevator, possibly. But real collectibles is a very, very long cycle. I mean, I've got boxes of trading cards. I haven't looked at them in 35, 40 years. I just recently heard how much trading cards were worth because I wasn't paying attention, because they were absolutely worthless. Like, there was a period I remember back in the day when I'm growing up, and we would look at the prices, and the prices were valuable. They weren't obnoxious valuable, but they were valuable. You get into my college and post-college years, they were literally worthless. Like,
Yep.
nobody wanted them anymore. So it blew up again. But I mean, what are we talking? A 25-year cycle before they just became popular again by a generation that is really keyed into nostalgia. And what happens? It's already drifting away. You talked about cars. I have an MG. I know I want to sell the MG. I kind of missed the window where the last couple of years, the price really popped. It's come back a little bit. But I mean, it could be 20 years before of a decline of those trends again, as generations move into a different place. And to me, the access to it, there's a huge moat around it, is extremely difficult to get into the real asset. The ability to get out of it is something that, again, if you have the liquidity and wealth to do so in other areas, sure, maybe. But again, is it something you want to hold on to? Because that's the other thing. Even with crypto, let's go back to, they say get it off the exchange, have a key. Now you got to deal with cold storage, because if you really want this thing to stay safe, you've got to figure out a way to store it. Like, but you've got boxes of Air Jordans, and you're going to sit on these Air Jordans for 20 years as collectible. You got to have a place to do it. So It's kind of like owning real estate. There's a cost of having that real estate, that asset, continue to be stored in a way that it's going to look, to stay, the high quality. And I cringe because I used to be a collector of GI Joe toys, and I used to be, as a kid, I played. I wasn't a collector. I played with them. I had all the Transformers. I had all the Star Wars. I had the Millennial Falcon. And I went off to college, and there was a neighbor kid, and my mom let the kid play with them. I only have 10% of all of them that I had. He broke them all, destroyed them all. Then I go and find the Millennium Falcons, alone is worth like $1,000, $2,000 out of the box. I just want to cry. Yeah. I mean, it's insane. And so no, would I recommend? I mean, I think that these concepts are taking Philip's original thesis, coming back to him. And by the way, I'll say this last thing about art. I was out on art when it became modern art. I'm when the Pollocks of the world, it's like, look, I've got drop cloths that have
Yeah.
that I can that have a more recognizable pattern on them than anything he produced. I remember
True.
going to the Guggenheim and walking through. It was a modern art exhibit, and it's like it was a shoe in the middle of the floor. I'm like, huh, it's my garage. Wow. I got 10 of them going, wonky. I mean, it's like it's in the eye of the beholder, as they used to say. It's in the eye of the beer holder, right? It's just, there's something completely different about that I was never got in. And what they're doing is now these days, they're taking Phillips' thesis. They're democratizing it as an investable asset. They're wrapping it up in these promotional Gen Y, Gen Z, TikTok friendly marketing packages as a cultural hook, as a generational wealth narrative. There's a desperation. There's be trillions of dollars. There's an accessibility play in these fractional ownerships. Um, and there is one thing that is changing. I think is another tie-in is AI. The one thing about this that might be something that could be longer term comes into where AI, if there's one thing that it is helping in this area, it's actually starting to uh, give accessibility to authentication. Now, we know with AI, there's a lot of hallucination, so I'm not sure right now I'd fully trust AI as my authenticating source. But I think over time, that's going to be something that will continue to be, higher quality. That's going to give that might give a little bit more of a foundation to this collectibles, longer term. Will flex, access, wealth narrative continue to be something that's going to be important, or will the unfortunately increasing ADD span of the youth move on to bigger, better things? Um, that part, to me, it's to the average individual. If that's something you love, great, get into it. Am I going to recommend bringing it up as something? Not until there's actually an accessibility that's trustworthy, as a piece that they can hold as a non-correlated asset, maybe. But I don't think we're there right now. And I think, to me, if we're taking and rebranding all of this to the TikTok era, it's becoming less and less of art as an alternative asset for the wealthy, but art as a flex, with sneakers or trading cards or gaming collectibles or watches. Um, the psychology is changed from distinguishing between the elite to just a status symbol, an investment mindset, a wealth narrative. And to me, as you said, that's trendy. That's a not a bull market, but that's a bubble. And I don't know if that's necessarily going to be something that's just recommended as general advice.
Yeah. So we're gonna wrap it up here. So Phil, final thoughts, and where can people find more about you?
Sure. Thanks, Kirk. So I think art is like any other investment in one way. If you want to do it, you got to make sure you know what you're doing. And it's not for everybody. And it's not the same as a lot of other investments. And this applies to all collectibles. And I mean, I have boxes and boxes of baseball cards and hockey cards and football cards in my basement too that are just sitting there. And someday I'll do something with them, I think, but I'm not sure. It might be something left for my kids. But on all these type of things, if you want to think about doing something like this, you need to get somebody that knows what they're doing to help you. I wouldn't venture to do it on my own. Uh, I'm Phil Weiss. My firm is Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. As I said, my firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website, which is Apprise Wealth. That's APPRISE wealth.com. And if you add the /5-things to the end of it, you can download a free copy of 5 Things Every Woman Should Know About Finances. Thanks for having me on today, Kirk. Enjoyed talking to you and Doug.
Yeah, thanks for coming on, Phil. Doug, final thoughts from you.
Thanks. Kirk, you and I love when we talk to bust big myths around things. And the truth is that bad myths, bad assumptions are what drain wealth, not build it. And it's the same with investing in these cultural assets the younger generations are flocking to, whether it's from fine art on, on these, fractional shares or sneakers or cards or NTFs. Philip Hoffman proved years ago that scarcity and curation drive value. Some of these ways to access it, reframe it as a flex for the TikTok era. Gen Y and Z don't see shoes as shoes. They see them as limited edition assets with appreciating markets. And that mindset is shaping the next wave of wealth transfer. But here's the lesson. Whether it's property, Picasso's, or Pokemon cards, myths and marketing don't create scarcity. Income planning does. It doesn't matter if you have $3 million, $5 million, or more. Without an income plan, you'll still worry about running out. And college, well, that's one of the biggest drains on future income if you don't plan it right today. Affluent families, they have more assets, so they might be more interested in these art or these collectibles and have the means to do it. They're going to have more income generally, but they also have more to lose. And the outliers are going to win because they do it differently. They're going to challenge these myths. They're going to climb to the top rope. And by the way, college planning right now, the Department of Education is run by the WWE. So the smart families are going to climb to the top rope before Washington or Wall Street can put them into a figure four, and they're going to coordinate everything from collectibles to college inside one cohesive wealth plan. Do it different. Learn about our our one plan at Mergent Group. You can protect your income, and you can learn more by visiting mergentadvisors.net. That's MERGENT, mergentadvisors.net. Or more specifically, for one of the greatest fleeces of your wealth, college, go visit mergentcollegeadvisors.com. And let's make sure you're writing the playbook, not getting pinned by it.
Great. Well, thanks, Doug. Thanks for coming on the show. Thank you both. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.